are chart patterns that every trader should watch out for. Now let's take a look at the first bullet point here, using pivots and reversal patterns to exit with profits. I'll start off again here with eBay. A quick example. Let's say we're in our short from 61.5 and it's starting to get a cut pattern reversal and a bottom. This tells you, say, 3 candles in a row here on the uptick, and then it's getting back over our entry. We'd go ahead and cover that out either even or with the small loss, and then go long with an additional amount of shares and ride that up. And again, I would be out here close to the 62, which is the previous high, or trail a very close stop. It's unlikely that I'd get all the way up to the 62.5, but I would take the half point on a long from here to there. Okay, so the point is, if you see first sign of a trend reversal and your counter trend, you want to make sure to get out of that position. Same thing here on the upside. If you're long, and let's say you had bought the breakout here over 62.25, 62.4, and it's starting to show you, you see 3-4 red candles in a row, that tells you, hey, I better be out here soon. You don't wait for it to drop all the way down here to take a stop loss. You be out of the position at the first sign of trouble and tell yourself, okay, I'll re-enter long if it gets back up over here, say over a previous high. Okay, let's take a look at another example here, LRCX. Same thing, pivots and reversals. We're here, this is a 2-day chart. It made a quick cut pattern and got some buying on the open, so a long signal would be over the 30.15, 30.2. Goes up here. This is the first sign of trouble in this stock, is you're seeing a small descending triangle. Again, this is micro trading. You really want to pay close attention to 1-minute candlestick chart and trade accordingly. Again, this is 1 minute, 2 minutes, 3 minutes, 4 minutes. It doesn't give you a whole lot of time to react, and that's okay though. I mean, typically we're in our trades for up to 10 or maybe 15 minutes maximum. Typically though, trades, especially during this first half hour, are anywhere from several minutes up to maybe 8 minutes, 10 minutes on the outside. So this is the first sign of trouble in this stock. If you'd held it, it would have just chopped around, but many times it would sell back down to the range, and you don't want to give up this profit. That's why you trail a close stop. You're in long here, it's going up here, you trail a really close stop, say within a spread or two. The red band on level 2 is a maximum trailing stop, and then it takes that out on the way back down here, and you exit with a profit on the trade. And that's the key to trading, is taking these small consistent profits that are larger than your stops on a regular basis. You're not waiting for it to make a 2-point run for you, or even a 1.5 or 2. You're trying to get half a point to a point on a consistent basis on your wins, and say 0.2 or 0.3 of a point on your stop losses maximum, so that it ends up net profitable for you at the end of the day. Next bullet point, 4 chart patterns to avoid, the red light caution charts, and these are important to know. First one is a choppy chart, and these are what I call broker specials. Brokers like these because the stock's moving in a very tight range here. When a stock's doing this is Amgen on a 2-day chart, by the way, you're not going to trade it, right? It's not giving you strong signals. You might be able to get in on a long, get out on a short, but it's unlikely in this. It's only about a half-point range here, like that Intel example from earlier. A choppy chart is not yielding signals. You want this thing to break out over, say, in this case, the previous day's high is right at, say, 63.1. Our long signal would be at 63.5. Remember, we're in at about half a point over the previous day's high. So it didn't get there, and we're not in the trade. Okay, so you avoid those kind of charts. The other type, second one, is narrow charts, or a very narrow trading range. Let's look at Manugistics, MANU. This is a 2-day chart. You can see this thing's been in a very tight range here, maybe half a point, 5/8 of a point for most of 2 days, and so that's not giving you anything to trade with. So this is the type of chart you don't even want to touch. This is telling you nothing. I'm never going to trade this kind of stock. It's not going anywhere. Volume's very low. Look at this thing. It's trading. You can look at the magnitude or lack thereof of the volume down here. 5, 10, 15K bars. Compare that with anything that's active like at Qualcomm. You see 50K, 100K bars. Big difference. You have much more sustained power on the trends. Let's see. What else? You don't want to trade low volume stocks either. Here's an example, McAfee, MCAF. Same exact thing. Look at this. The entire morning the thing's probably traded 10, 15, 20,000 shares. You would never trade this type of stock Summary, those are the 4 types of charts to avoid. Is the very choppy charts, ones that have very narrow trading ranges, those that are low volume, or those that are very cheap, the under $10 or $15 stocks.